Hello, Leeb Group viewers. Today is Wednesday, September 21st. The year is 2011. Make sure you visit leeb.com, Leeb.com. Sign up for our free financial newsletter. Leeb's Market Forecast will give you a new report we wrote on inflation survival tips. So all eyes were on Washington, D.C. today as the Federal Reserve policy decision-making body wrapped up a regularly scheduled two-day meeting. The Fed announced plans to sell $400 billion U.S. in short-term treasuries and invest the proceeds in long-term government bonds in an attempt to bring long-term commercial rates down. The media has dubbed the widely anticipated move, quote, Operation Twist, invoking the name of a familiar monetary initiative launched in 1961 under then-President John Kennedy. The idea is that since business investments and mortgages are more sensitive to long-term rates, lowering those rates should stimulate more business investment and housing demand. Realistically, however, the impact of the move is not likely going to be significant, according to San Francisco's Fed research. The original Operation Twist 50 years ago lowered long-term yields by a mere 15 basis points. In addition, the long-term yields are already at very low levels. For example, 30-year yields are at the lowest point since the beginning of 2009 at the depth of the financial chaos several years ago. Despite such low rates, the level of economic activity and housing demand haven't exactly been robust. It's hard to envision that another incremental decrease in the yield will suddenly light a fire. The Fed also announced it will reinvest maturing principal payments from holding of agency debt and agency mortgage-backed securities in agency mortgage-backed securities. It will also maintain an existing policy of rolling over maturing Treasury securities. In other words, the Fed will not let securities in its portfolio mature, thereby keeping the dollars in the system, but this too isn't exactly a home run swing. Thanks for dropping by. We'll see you tomorrow.